Thank you all. Good afternoon and welcome today. Today's webinar is focused on financial literacy. Allow me a moment to introduce myself and our team. I'm Keith Barberis, Certified Financial Planner and Managing Director from Barberis Wealth Management of Steward Partners in Bethesda, Maryland. I have over 25 years of financial industry experience. Steve Lynch is a 30-year veteran of the industry and has held roles as a financial advisor in management and operations. And Michael Kushwa, 6 years industry experience, and his title is Vice President and Client Administrative Manager. For those of you unfamiliar with Barberis Wealth Management, our goal is to educate families and help them secure wealth so that generations can meet their full potential. We empower families to live their best lives and hope that by doing this, we can be lifelong partners for you and your loved ones as we help generations of your family navigate life's ever-changing life stages and transitions. And perhaps along the way, you'll introduce us to a few other people that you care about. Today's presentation will last about 35 minutes. We'll also have a few minutes at the end for questions. So we should have a hard stop at about 5:15. With that, I'd like to introduce our sponsor today, Joe McGreddy from Jackson National. Thank you, Joe, for putting this together for us. Jackson has been a wonderful partner for our practice in helping us find appropriate solutions for the families that we serve. Today's featured speaker is Kyle Elliott from Invesco Funds. Kyle joined Invesco when the firm combined with Oppenheimer in 2019. He joined Oppenheimer Funds in 2013 as a regional advisor consultant. And most recently, he's been a vice president and sub-advisory consultant. Kyle's earned a BS in business administration from the University of Rhode Island. He's a certified investment management analyst and holds the Series 7 and 63 registrations. Kyle, we'll turn it over to you.
Excellent. Thank you, Keith. Let me just pull up my screen. But first and foremost, thank you everyone so much for the time and the opportunity. As Keith mentioned, my name is Kyle Elliott. I'm one of the wholesalers for Invesco's retirement insurance team. I'm going to go through our financial literacy presentation. And as Keith mentioned, any questions that you have, just save them for the end. Happy to take them, whether they're on, some of the content that I'm going to talk about today, or anything market related. I'm talking to financial advisors and professionals kind of on a daily basis about capital markets. So anything on your mind, I'm happy to do my best and answer it. So, basically, when we start to talk about financial literacy, we kind of identify a problem. And I think the biggest problem that's out there when it comes to financial literacy is that, we really, generally speaking, we don't talk about money enough, right, in society. And, there's the old Andrew Carnegie quote at the top here that we go from shirt sleeves to shirt sleeves in 3 generations. Right. So the problem is, number one, we tend not to talk to our kids about money. Some of those reasons for that could be, we're afraid that they're going to discuss it in the wrong company, or maybe it'll change their values, or maybe they'll start to worry about our situation. Sometimes we don't talk to our spouses about money, right? Maybe because it might cause stress, or it could lead to a fight. Or we think, he doesn't know anything, or she doesn't know anything, or, it's his job to worry about the planning, or her job. And, lastly, we sometimes don't talk to our parents about money. Maybe we're afraid that they're going to misinterpret our intentions. Maybe they never really discussed it with us. Maybe they'll worry about our situation. So we end up not talking about money really enough. And that in itself can kind of create some problems. So, with that said, we created this program, and we go through 3 different sections on, really some of the things that you should focus on, or at least be aware of. And the lion's share is going to be around the accumulation stage, accumulating assets, how you're earning money through your career. How do you get started? How do you potentially defer some gratification? What are the investment decisions that you need to make? What are the big decisions that you need to make in life? And then next is, how do you protect your assets? Then ultimately, once you do decide to retire and you're no longer earning money, or at least at the rate that you were in your career, how do you think about that final stage, that distribution stage, maybe even that, the estate planning aspect of things? So, we say that everyone has a role. Think about your families and maybe think about them in the context like an organization, right? You have your co-CEOs. So, if you're a mother or father on the line, you're typically the co-CEOs, and it's your responsibility to kind of develop that strategic long-term financial vision. Maybe you're monitoring and recording your finances, you're making kind of the strategic investments. And then most importantly, to me, you're training those next generation leaders, right? The associates, AKA your kids, right? And we need to take that seriously, right? You have to have these types of conversations with your kids. And, you need to kind of give them the ideas or what they should at least keep in mind at each stage of their life, right? And I'm talking about as early as, when are they opening, at what age are they opening bank accounts? At what age are they going to be investing their money? When are they going to be involved in those wealth management conversations? So if you're the parents, you're the CEOs, your kids are the associates, and the CEO, emeriti, the matriarchs, the patriarchs of the family, they're kind of there to promote family legacy, distribute resources to the next generation of leaders, and then ultimately make sure the co-CEOs are prepared for the future. So, again, think about your family and then maybe think about it in the structure of an organizational chart, and how you want to start preparing your kids for when they might inherit that money at some point. So, we think about accumulating, and it's really not just about accumulating money. I mean, what are we trying to accumulate? And we put a few words here, whether it's, choice or means or freedom or happiness. How do you accumulate those things? And, Tolstoy says, we have his quote on the side here, there are two ways not to suffer from poverty. The first is to acquire more wealth. The second is to limit your requirements. The first is not always within our power, but the second is always in our power. So, AKA control the controllables, focus on the things that you can control. Obviously, you can control what you spend, what your expenses are. And, when you think about wealth, it's really all relative. You think about it from the perspective of the Burj Khalifa, the world's tallest building, or at least when we made this, it was the world's tallest building. And, if you're in the US and you're a couple making over 600,000 a year, and you're in that 1%, you would in essence kind of be at the top floor of the Burj Khalifa, right? And that's illustrated all the way on the left there. And, if you're on the top floor, maybe, you're feeling pretty good about yourself. As you're looking down on the lower earners there, and you're at the top floor. That's until Patrick Mahomes walks in the door, right? That's until an NFL quarterback or someone making 40 or $50 million walks in the door. And now, relative to that person, you might be at the bottom. And Patrick Mahomes might be feeling great until Larry Ellison then walks in the door. And Larry Ellison might be feeling great until Mark Zuckerberg or Elon Musk or Bezos or whoever it is walks in the door. So, our point here is there's no number, right? It's all relative, but there's no number with which to strive. It's more about accumulating what you want in life. It's about, your choices. It's about your freedom, your happiness. It's more than just some dollar amount. And, one way to think about it is just by time, right? Measuring wealth in time, because you can control multiple elements of that. It's not to say, I have X amount of money, so I'm rich, right? Because it also depends on what your expenses are, right? There's that other side to that equation. So, we have a couple examples here, but say you have $20,000 and you're spending $5,000 a month. Well, then you only have 4 months of financial cushion. So, probably not great. But if you have $1 million and you're only spending $5,000 a month, well, that's 200 months of financial cushion, 10 million, right? 2,000 months of financial cushion, right? So it's probably a better way of looking at it, because it starts to get us thinking about not just how much you have and how much you've saved, but kind of that other side of the equation. What are your monthly expenses looking like? And, when we think about accumulating money, one of the best ways to do it, and one of the best ways to increase your earnings potential, frankly, is to invest in yourself. people always ask, what is the best investment? And the best investment, generally speaking, and obviously I'm sure we all know people that maybe didn't even graduate high school and they became a very successful business owner. But that tends to be the exception, right? Generally speaking, the best investment is in yourself, whether it's advanced degrees or just kind of degrees in general. You look at, median lifetime earnings, whether it's from no high school diploma through maybe a more professional degree. And obviously it goes up significantly the more you invest in yourself, right? So just one thing to keep in mind, and it's a lifelong process, right? A lifelong learning process that should never stop. The other thing I would say is you want to start early. I mean, for those of you that have young kids, or I don't know if anyone on the call today is in college or about to graduate college, but, start as early as possible. Right. Adam Smith, in the Great Economist in the 1700s, he said that money, says the proverb, makes money, right? Money makes money. When you've got a little, it's often easy to get more. The great difficulty is to get that little, right? And the way to get that little is really just to invest early and often. So we have 4 different examples here. Folks that started investing earlier, some folks started investing a little bit later, but you kind of see the power that compound interest has, even starting, 5 or 10 years earlier than some early on in your career makes a huge difference by the time that you retire. So we have Jane, John, Susan, and Chris. Jane starts investing at 25. Now she's putting, we're just using this as an example, 20,500. Looks like she's maxing out her 401k, and obviously everyone's different. We'll just use 20,500 as the example. But by the time she is 65, right, over that 40-year period, she has now contributed $820,000, and we're assuming about a 6% return on those investments, market return on those investments. And over that time, she's earned $2.5 million, right? By the time she's 65, when you combine that with the contributions, she's got over 3 million, almost 3.4 million, versus someone that maybe waited to start investing, or they just started later on in life, right? Susan, for example, who's 45, she started 20 years later, so she was only able to contribute 410,000. Because of that, because it was a shorter time in the market, she only earned about $400,000 on those contributions. So, by the time that she's 65 and was ready to retire, her end sum is significantly less. So sounds very, very basic, but it's absolutely critical. Again, Adam Smith's point, remember, money makes money. Time in the market, right? Money has time value. The longer that you are participating in the market, historically speaking, the better that you have done. So keep in mind, starting earlier typically does yield much better results. We talk about the—
Kyle, can I jump in real quick on that last point?
Sure, Keith.
Compounding, just very simply, is growth on the growth, right? So as your $10 becomes $11, now you got a 5% return or 6% return, as it says here. The next year, that $11 is now earning 6%, and then that amount is earning 6% going forward. So it's growth on growth. Sorry.
Absolutely. Compounding interest, great point. And probably, again, for you folks that are parents and have younger kids or maybe teenagers, probably be a good idea to share this type of slide with them, just to talk about the importance, even saving a few bucks a week. If they have, a summer job or something like that, it definitely adds up over time. And certainly once you start actually working in your career, the earlier you start, the better off you tend to be once you retire. So, we talked about deferring gratification, and we have another quote here. Tolstoy's quote is great. But I love the Will Rogers quote. It's too many people spend money they haven't earned to buy things they don't want to impress people they don't like, right? And I suppose or suspect that we all know people like that, but there's some pretty high profile examples of this, and not to, pick on anyone in particular, but you see, some people on the left here, they've generated, some pretty substantial lifetime earnings, but they end up unfortunately going bankrupt. Maybe they spent, their money on things that in hindsight they probably didn't need. On the flip side of that, the right side of the slide, you kind of talk about, or maybe you've heard about the idea of the millionaire next door, right? The millionaire couple next door. And, when you start to look at their profile, it's pretty interesting. I mean, the millionaire couple that we have, their profile, they make $247,000 a year in annual taxable income, but they're worth over 3.7 million. Now, how could that be possible, right? And that's because in general, when you look at some of their habits, their likes, it's things like living below their means, it's budgeting, it's education, it's investing early, right? It's that growth on growth that Keith was talking about, right? And these folks in particular, they invested nearly 20% of their household realized income, and they do that every year, which maybe that's not realistic for some. Obviously, everyone's situation is different, but kind of identifying how much you're comfortable with saving and investing, again, adds up over time. And certainly when you're talking about compound growth, it really adds up over time. When you look at some of their dislikes or some of the things that they wanted to stay away from, excessive spending, no margins for error, laziness, excuses. And, to me, I always say that there's a difference between being rich and being wealthy. I think, for the rich, it's really the spending that they do is how they want to identify themselves, versus the wealthy. It's really the investing that they do over time, kind of staying on that consistent discipline plan. Other things we can do is beware of little expenses. When you think about deferring gratification, some of it is, money we spend that we might not even realize that we're spending on a daily basis. And if you look at the average income, this is from 2 years ago, I think, but if you look at the average income here in the US, it's a little over 67,000. And then you look at what is estimated to be the money that's wasted on little expenses each year, right? It's about 12,500, or 18% of those average yearly incomes. And, you look at some of these expenses, whether it's a gym membership, and gym membership's obviously not a bad thing, but a lot of times, I mean, how many people sign up at the start of the year and never end up going? Right? Wasted food. We waste a lot of food in this country, or things like gambling, or credit card interest, or money that's, spent on coffee, or cable TV, or inefficient energy systems. You can point to a lot of different things. And just to kind of give you an idea, maybe even put a finer point on it, we use the example of coffee. Now, coffee obviously is not a very big expense at all. Maybe we call it $2.95 a day, maybe more depending on where you go. But when you look at the dark blue bars and you think about your career, right, if it spans roughly 40 years, you think about the first 5 or 10 or 20 years of your career. If a cup of coffee is $2.95 and you're buying it every day, well, over those 5, 10, 20 years, you're going to be spending around $5,000 to $20,000 on coffee, right? Over a 40-year career, you're spending $43,000 on it. Now we look at the flip side. What if you had taken that money and instead of buying the coffee with it, right, you invested? And here we're kind of getting into opportunity costs. And I'm not saying at all you should stop, drinking coffee by any means. But when you look at that $2.95 invested every day at a 6% annual growth rate, instead of being down 43,000, you've gained, or you've earned 177,000. So again, just an example. We're not telling you not to drink coffee, but maybe think about if you buy it every day at Starbucks or your local coffee store, maybe making it at home, finding little ways to, again, avoid some of these expenses, because these little expenses do become big opportunity costs over time. Other thing, I mean, the bigger the purchase, obviously the bigger the opportunity cost. Coffee is clearly a smaller purchase, but, we use this example. You look at a lot of people that inherit money. You find that when they inherit money, they end up buying big things, typically a new car, pretty soon after they inherit that. And the question kind of becomes, what car do you want to buy? And let's say that you come into $100,000. You have 4 different options here. Do you want to buy the car that costs $18,500 that we show at the top? And if you buy that car for $18,500 and you invest the rest, right, that remaining $81,500, well, over a 30-year period, a 6% rate, that $81,500 grows to about $500,000, right? Or maybe you decide to buy that $46,000 car and invest the remaining $64,000. that only grows to 326. Or maybe you really want to splurge and get the nice sports car for 83,000 and invest only that 16,000. Then that 16 only grows to 97. So that is the opportunity cost. You do get to drive a nicer car. Then you kind of break down average life expectancy of the car, and maybe it's 8 to 10 years or so, maybe more if you take good care of it. But the question kind of becomes, and only you can answer it. I'm not telling anyone what to do, but the question becomes, is it worth it, right? Would you rather buy a lesser value car, invest the rest, watch it grow over time? Again, the bigger the purchase, the bigger the opportunity cost. A few other things, and there's a lot of ways to think about deferring gratification, but the final point I'll make on it is just to make sure that we know that there's good debt and bad debt. There's some we consider better debt, but again, not deferring gratification, not always buying things on credit typically tends not to be the best decision. If you look on the illustration we have on the left, you have $1,000 smart TV. If you pay that statement balance on the credit card, that's fine. But if you pay $100 a month, well, that $1,000 TV might now become $1,100, right? If you only pay the minimum balance, that $1,000 TV by the time it's all said and done, it becomes $1,500. So, again, the question becomes, is it worth it? There is, though, better debt. Better debt would be things, at least in our opinion, things like student debt, which is an investment in your future, potentially beneficial for your wealth and future earnings. And, we talked about annual lifetime earnings going up with higher degrees. And you are, of course, with higher degrees, you are less likely to be unemployed over your lifetime. So investments 101, there's a lot to be said about investing. I think the reality is, and just some simple things here. Number one, you want to create an emergency fund first. Then from there, you kind of determine which assets you're going to invest in. You don't have to be safe to succeed. And I'll kind of talk about what I mean by that in a few slides here. But then you want to diversify your assets or your investments, automate your investments, try to minimize taxes, beware of hot tips, and then again, seek professional advice and stick to a plan once you've made it. I'm not going to go through every one of these, but I will hit on a couple. The first one is building your emergency fund. Just in general, people sometimes ask, how do you get to what your emergency fund should be? And, I like to keep it simple. You can ask yourself, what are your monthly expenses? What would it be like if you were unemployed? How long do you think it would take you to find a new job? Would it be, 3.75 months, which that's kind of the national average? Would it take you 6 months? Maybe you're out of work for a year, maybe it takes you 12 months. Whatever you think it could take, I take my average monthly expenditures, I multiply it by how long I think I might be unemployed. And then that kind of becomes my emergency fund. And so, I think that's kind of a good starting point. Once we build that emergency fund, you then kind of start to think about, okay, how do you invest your money from there? And, a lot of people think that being safe is being smart with their money. The problem with being safe is that oftentimes you don't really get anywhere. And I'll preface this with saying, obviously, everyone's situation is different. It's really dependent on your time horizon. If you need the money tomorrow, then yeah, you're probably not going to get into a very volatile investment strategy. But if you're 23 years old and you're looking to retire in 40 years, and you're not going to touch the money until you retire, then you want to think about getting a little bit more aggressive. But, just generally speaking, if you look at some of the numbers here, and you think about the last 25 to 30 years, and, we're looking 95 to 2019. So obviously not or 2021. So obviously not the current environment, but for the last couple of years, CD rates, they were yielding around 2%. Inflation at the time was around 2%. So in real terms, right, your rate of return minus inflation was really nothing. It was really zero. It was almost like being in cash and earning nothing, or almost like running in place on a treadmill. We look at the middle illustration, average bond yields was around 4% over the last 25 years. After you account for inflation, the real return is only around 2%. So, you look at $100,000 investment, it grew to 164. So not nothing. You jogged a little forward, but nowhere near, had you gotten a little more aggressive and maybe invested in equities, We're looking, since 97, so average rate of return on the S&P was around 10%, minus 2% for inflation. You're looking about an 8% real return. So, and your 100,000 obviously grows to 684,000. So you kind of scaled new heights. Again, just something to keep in mind. Everyone risk tolerance is different, but again, you don't have to be safe to succeed. It's actually quite the opposite. We talk about automating your investments. The good thing about automating your investments is threefold. Number one, you pay yourself first, kind of out of sight, out of mind. And then lastly, as we talked about, you're increasing your time in the market, right? That dark blue line, we were thinking about, okay, how long would a career be? Said, okay, 40 years, 1980 to about 2020. If you make these monthly contributions, so these are monthly contributions, is that dark blue line, you kind of see where the dark blue line climbed to 1.8 versus the light blue line, where you yourself kind of decided to make a year-end contribution, which is what some people tend to do. And if that makes sense for you and that's the best thing that you can do, then that's fantastic. But we certainly recommend trying to stick to monthly distribution, monthly investments and trying to automate it versus making those year-end contributions, because frankly, there's a lot of times maybe you forget to make a year-end contribution, or maybe you don't make it because life kind of gets in the way or market events happen. So if you look on the bottom where we show the years and those blue circles with the lines through it, that was an example that was associated with the light blue line and the years that the investor forgot or just did not make those year-end contributions. And obviously only 5 years out of 40, but you see the pretty big impact that it had on the end result. Again, time in the market, longer you stay invested, historically speaking, the better off that you are. Another point to make is just when it comes to investing, the longer that you own an asset class, the more likely it is to exhibit the characteristics for which you bought it. A lot of times investors will buy things that don't do what they think they're going to do, at least initially, and then sell them, and they don't actually stick around for the asset class to exhibit the characteristics for which they bought it. So here's an example of what we're talking about. You look at the percentage of time on the left here, the percentage of time that treasury bonds outperformed cash. You would think that would largely be the case, right? But when you look back, at least to 1979, for every 3-month period, you're only 2 out of 3, right? Over 10 years, it's 100%, right? So longer that you stay invested in a certain asset class, better chance it has to exhibit the characteristics for which you bought it. Same can be said for large cap stocks over treasury bonds. Again, 3-month period, it only outperforms, 2 out of 3 times versus 10 years, it's over 100%. And then lastly, percentage of time large cap stocks outperform bonds. You would think that would be almost all the time. Well, every 3-month period, it's only 62% versus every 10-year period, it's around 80%. So, the percentage of time, again, longer you stay invested, longer that the asset class has the opportunity to exhibit the characteristics. We move on to big decisions here, and through this, we kind of provide different checklists, whether it's married couples, what are some of the things that you need to do to get your finances in order? What are some of the things that you have to update? Maybe what are some of the new considerations you have to think about, whether it's wills or life and disability insurance, checklists for new babies, for example, what do you need to do or be thinking about pre-delivery? What do you need to do in the hospital? What do you need to do in the first 30 days? Maybe what are some of the things you have to be thinking about beyond the first month, whether it's ordering birth certificates or social security cards, or adding your child to health insurance plans, or opening a 529, and all these different things that you might not be thinking about, when you're trying to enjoy a newborn baby. This next one, should you rent or buy a house? For a lot of people, it's not as easy a decision as you might think, certainly right now with what's going on in the housing market where rates are. But, when you pay rent, theoretically, you get to invest the rest that might have to go to property taxes or a mortgage. When you buy a house, you've got to pay the interest, put money down, pay the property taxes. Yes, you get the deduction, but it's not always that easy. So here's kind of some simple math here, and maybe try and determine for yourself whether renting or buying makes sense for you. And again, these are just some of the big decisions that investors are going to have to make. And obviously your advisor team can help you with that. When you do get a bonus or maybe any type of windfall of money, should you pay off your house or invest it in the stock market? And a lot of people just say, well, pay off the house, why have that liability? But, for a lot of people, especially right now, that liability was borrowed at a very low interest rate, right? So the question becomes, can you do better in the market? And, when you look over time, 10-year rolling monthly price changes in housing, it was pretty modest. At least back to the 60s here. And if you look at equities, the average annual return roughly around 10%. So, if you're borrowing at a low rate and you have a windfall of money, the odds are you'll probably do better over time, at least investing in the equity market. And again, yes, you'll still have to pay interest on that mortgage, but if you can do better in the equity market than your borrowing cost, then you will be better served in doing so. Next is protecting. What are some of the things we need to think about when we're looking to protect what we've accumulated? Again, your choice, your means, your freedom, your happiness. And I'll show you a couple of these slides on the protection aspect of it. But, we go through this and we have the quote from Gandhi at the top, live as if you were to die tomorrow, learn as if you were to live forever. So what are some of the things you need to do? You need to be prepared in case you were to break down on your journey, right? With maybe some type of healthcare directive or power of attorney, you need to be prepared if you die too soon, right? Things like life insurance or wills and trusts, or maybe even being prepared if you live longer than you expected, whether it's things like long-term care or maybe not trying to be a particular burden on the next generation. And I'd also say, make sure you're not overinsured. Obviously, insurance is very, very important, and everyone's different, but maybe trying to bear some of the risks that you can afford. Sometimes the items on the left here become a little bit expensive over time, and maybe we can bear those risks and we don't actually have to insure all of those things, but you do need to insure the risks that you can afford, right? Whether it's your family's well-being or your future income or your health. Or your house and land, your future income and potential liabilities. So those are really the things, types of things we want to insure. So let's just make sure that we're not over insuring ourselves. And in terms of protecting, a lot of that happens in the retirement years. A lot of people think about how to invest in retirement and, they want to be protected. The problem is, you tend to have a pretty high withdrawal rate in retirement, pulling money out. And so, we look at three lines here. The bottom line is you're all in bonds and withdrawing 6% a year. And you might say that, okay, well, 6% is too much money or it's too high. But just for the sake of the argument, let's just say you're withdrawing 6% a year. And over many years of retirement, you kind of run the risk of running out of money. And you compare that to a 50-50 or going 100% into equities. And with both of those scenarios, you actually end up with more than when you started. So point here is I'm not advocating 100% into equities in retirement, but the 100% stock portfolio fared the best. So, we want to protect, but we also don't want to protect beyond what's necessary, even in retirement. And then lastly, distribution, right? How do you distribute choice, freedom, happiness, means, and really how do you set up the next generation? I would say, focus on your virtues and your values. What's most important? Is it philanthropy? Is it hard work? Is it entrepreneurship? Is it higher education? What is most important for your family? And make sure you structure the way you spend your money and structure the way you establish inheritance around those things. When we talk about structuring inheritances appropriately, make sure you're doing it in a way that promotes self-sufficiencies. That are based on goals, not emotions. The last thing we want to do is leave, so much that it distorts ambition. You obviously don't want to rule from the grave, and you also don't want to neglect any warning signs, that maybe our adult children are poor money managers. So making sure you structure that inheritance appropriately. And then lastly, I just wanted to share a couple slides from a behavioral finance chart book. I think, a lot of this content is more important now more than ever, especially with a lot of the volatility. Maybe this will answer some of the questions that you have on your mind. But we created this program, Navigating Volatility, that was basically built on the notion that more money is lost due to fear than just about anything else, right? More than market-related events, more than geopolitical events. It's really investors' emotions and behaviors that end up essentially being their downfall and underperforming the market. So this is a very popular slide. It's in most of asset managers' chart books that they will put out for clients. We have the returns over the last 30 years of different asset classes, whether it's stocks, bonds, or the rate of inflation. And then we have the average investor that was trying to do it on, this is by themselves, by the way. This is an investor trying to do it on their own without the help of a financial advisor. And you could see that they, greatly underperformed what U.S. stocks had done. And people ask, well, how could that be? Why is that? And unfortunately, the biggest reason is their returns were lost on emotion. It was buying and selling at inopportune times, kind of letting their emotions get the best of them and not staying in that long-term disciplined plan throughout volatile times in the market and throughout different market cycles. We say no one has a crystal ball, yet people often act as if they do. And we talked a lot about, the importance of financial literacy, but also the importance of understanding that time in the market is really king. Keith and I were talking earlier about the power of compounding interest and the growth on growth on growth and the effect that has. But we also want to make sure that we are participating in the best days of the market. And people try and time the market. I'm sure a lot of folks are out there right now trying to time it, catch the falling knife, if you will, based on what the Fed is doing or what some of the headlines that they're reading. But it's incredibly difficult to time the market. And that's because the best and worst days are usually bunched together. And even over like the last 30 years, what we're looking at, the S&P 500 and the growth of $100,000, if you would have bought and held the S&P 500 since 1992, your 100,000 would have grown to about 1.5 million today. If you missed just the best 10 days over the last 30 years, your return is cut in half. You miss the best 50 or 60 days, your return basically goes negative. Again, the best and worst days are usually bunched together, and you don't even have to go back to 2001 or 2008. You just go back 3 years ago, right? There was a period in 2020, and I'm sure we all remember it, but it was like February 12th to March 23rd when the S&P fell 35%. A lot of nervous, scared people out there, and rightfully so. It was a very scary time for everyone, whether you're in the industry or not. But you had some of the worst days in U.S. market history. When you actually look back, you also had some of the best days in market history as well. Right, March 24th, 2020, the S&P was up 9.5%. March 13th, up 9.3%. So again, time in the market as opposed to trying to time the market has typically yielded the best results. This is a more fun slide. We built this one on the notion that, or the objection that we were getting, I don't want to invest in the market. It's a rigged game. The odds are stacked against me. It's basically like a casino, right? So what we did, we took the odds of winning various casino games, and we have the roulette wheel here, and whether it's, roulette or blackjack or craps or poker, whatever it is, your odds of winning those games are all under 50%. Then we compare it to rolling monthly returns in the stock market on a 1 through 15 year basis over the last 120 years. And in short, all this slide is really telling me is that the longer that you stay invested in the market, better chance you have at finishing positive or better chance you have at winning. I like to look at this as two tables, right? You got the casino table on the left, stock market table on the right. Longer you stay invested in the stock, or longer you stay at the stock market table, better chance you have to win. Longer at the casino table, better chance you have to lose. And then last but not least, every generation faces its fair share of challenges. And obviously there's a lot going on right now, and there's a lot going on the last couple of years, and we're not trying to minimize that in any way. But you look back on the last 120 years, and there's always something that's going on throughout the world, geopolitical or otherwise, where an investor can give a million reasons why they're not going to be invested. Whether it was the Great Depression or the Nixon impeachment or 2001 or 2008 or 2020. But then you see kind of the growth of the Dow over the last 120 years, and the growth of 10,000. Despite all those volatile or bad points in U.S. history, grew to about $4.7 million. There's a great quote from Warren Buffett. We used to include it on this slide, but he wrote an op-ed back in October 2008. It was in the Wall Street Journal, very, very famous piece. It was titled, "Buy America, I Am." And the famous quote was, in the 20th century, the US endured world wars, financial panics, oil shocks, the resignation of a disgraced president, yet the Dow rose from 65 to 11,500. So the point Warren Buffett was trying to make there is, look, we're always going to be facing bad things in throughout the world. And again, give 100 reasons why you don't want to be invested in the market. But when you see how resilient the market has been over time, there's really no reason to stray off whatever long-term plan that your team has mandated for you. So Keith, with that, those are my prepared remarks. So I'm happy to take any questions now, if there are any.
Great. Thank you, Kyle. I appreciate that. It was very insightful, very important. I think certainly for folks to get a sense of that. To me, the biggest takeaway on all of that is discipline, creating a habit that you'll be able to carry forward with throughout your life. Great. All right. Well, thank you all. In closing, thank you, Joe and Kyle, for sponsoring today's webinar, and thanks to all of you for attending. We hope that you feel that this was a good use of your time today and that you learned something. If you'd like the slides from today's presentation or to set up a time to discuss your personal situation in more detail, please reach out to us. Contact information is there on the screen, or you can simply do a search online for Barberis Wealth Management and visit our website and get our contact information from there.